are in listen-only mode.
Hi everyone, thank you for joining us today for a CalTRUST Short-Term Investing Strategies webinar. It's 2 o'clock, so I think we'll go ahead and get started. We have Chuck Lamelli, Solana County Treasurer and President of CalTRUST on the line, who will kick it off for us, and then pass it on to Mike Rogers with Wells Capital Management, who will be doing our presentation today.
Good afternoon, everybody. Welcome to our first webinar. For those of you that aren't familiar with CalTRUST, we're a joint powers authority formed by municipal treasurers in the state, by treasurers and for treasurers. We currently have 150 agencies enrolled in the program and over $1 billion invested. This webinar is a continuation of our recently launched education program, and it's the first in a series of educational webinars that we'll be offering in the near future. If there are any topics that you'd like covered on a webinar, please feel free to send that request over to Laura Labanier, and she can put them in the queue so we can set up a presentation for that. If you have any questions, there'll be a question section over on the right-hand bar that you will see in the panel there. It'll say questions. Click on that, and you go ahead and type your question in there. At the end of the presentation, Laura will run through those questions for you. And then also, I'm going to go ahead and at this time turn it over to Mike Rogers, who is with Wells Capital. He's going to be conducting the webinar for us today. And with that, Mike, go ahead and kick it off.
Great, thank you, Chuck. Thanks very much, everybody, for joining us today. The goal here is to make this a very informative presentation. So I very much encourage questions, and in my opinion, there's no such thing as a silly question. So feel free to jot down your questions as I move through the presentation, and we'll address those at the end, as Chuck mentioned. Some of the things that I'm going to be covering today is I'm going to cover a little bit of where we've been in the financial markets, some of the current challenges that we're facing today, and I'm sure the same challenges that you all face on a day-to-day basis in managing your portfolio. I'll also cover some of the potential risks and how to avoid those risks. I'll also cover where we're seeing value from a risk-reward standpoint, some of the things that we're actually doing in the CalTRUST program, and then how you can achieve your investment objectives in this difficult and very uncertain environment. So with that, I'm going to go ahead and get started here. Let me just get that slide change. This first page here is where we've been. As you all know, the Federal Reserve has signaled that they will not raise rates until sometime in mid-2015. Where we find ourselves is in a very protracted part of the business cycle where short-term rates have remained very, very low. This chart here just shows how highly accommodative the Federal Reserve has been with respect to monetary policy. This is the federal funds target rate. As you can see, following the credit crisis back in 2007, they've been very, very aggressive in keeping long-term or short-term rates very, very low. And currently, right now, this stands at about 25 basis points. A couple of headwinds that we're facing from an economic standpoint. As you all know, very widely publicized, one of the big Achilles heels in the economy and huge drags on the economy is the housing market. This continues to be problematic and creates an enormous drag on the economy. However, having said that, we have seen some recent signs of improvement. So we're hoping that the trend continues as, again, this has been a major drag on the economy. The other Achilles heel from an economic standpoint has been the high rate of unemployment. It's been, I think, unprecedented that the unemployment rate has been above 8% for more than 3 years. and just recently has ticked down to 7.8%. Um, these are two measures of unemployment that we pay attention to here at Wells Capital Management. The blue line represents the broad unemployment rate, which includes those working part-time out of necessity that can't find full-time jobs, and it also includes discouraged workers who have dropped out of the workforce. Uh, we like to think of this measure actually as probably more accurate, as more people actually prefer to work full-time as opposed to part-time and just settling. And then finally, we are tracking the unemployment rate. That does not include uh, the underemployment rate, and that again, as I mentioned before, is currently at 7.8%. So that's actually starting to recently improve as well. In addition to the drags on the economy, there are a number of things out there that are an issue. The storm clouds are forming in regards to money market mutual fund reform. I think perhaps a lot of you have read about this in the press. If you go back to what came out of the credit crisis in the Dodd-Frank bill, one of the things that money market funds have been mandated to do is they've actually been mandated to be much shorter. Previously, before the credit crisis, they were allowed to invest out to a maximum weighted average of 90 days. Now this has been decreased to a maximum average of 60 days. They have also been required to become more liquid as a result of some of the things that we saw back during the credit crisis. Currently under consideration, with regards to further reform, the SEC is looking at putting through and mandating a floating rate NAV. As most of you know, money market mutual funds currently have dollar in, dollar out, so that net asset value remains at $1. So as a result of the reserve breaking the buck, they think that greater transparency makes sense in a floating rate NAV. So this is one of the reforms that's currently under consideration. The other thing that's under consideration is a holdback of principal and interest of investors' money. And how this is supposed to work is if investors are to put money into a money market mutual fund and then need to redeem that, there would be some small percentage of a holdback for 30 days before you can get all of your money out. So for example, if a money market fund investor were to invest, let's just say for simple terms, $100 million into a money market fund, the holdback percentages that I've read about range anywhere between 3 and 5%. So if you put $100 million into a money market fund and you need to take that $100 million out, they're going to give you back anywhere between 95 and 97 million, and then 30 days later they will go ahead and give you back the remainder of your money. They believe that this would help prevent a run on a money market fund. As most of you may recall, when Lehman Brothers went down, we had the reserve fund actually break the buck as there was a run on the money fund because they had large exposures to Lehman Brothers. So this would help prevent that. The other thing that they're looking at imposing is a capital buffer, which means that providers of money market funds like a Wells Fargo will be required to have some sort of credit facility put into place in order to make sure that we could pump in capital into a money market fund. So this is perhaps under consideration for the entire money market fund industry. Recently, they were supposed to vote on this within the SEC, and because they couldn't get a majority vote, they've decided to kick it over to the Financial Stability Oversight Council. So now here, basically what's occurred here is they've kicked the can down the road, and this will now be addressed sometime in 2013. A lot of the uncertainty around these reforms are what actually is going to happen after the election, as this council is actually chaired by Tim Geithner. So we'll have to see what happens. But these are things that you should be aware of as investors, because these are things that you're going to have to deal with if 1, 2, or 3 of these reforms are put through. The other thing that's approaching at year end is the expiration of the transaction account guarantees. This actually is the unlimited FDIC insurance for non-interest bearing deposits that was provided as a backstop to banks back in 2008. And Dodd-Frank actually mandated that all banks must participate. Now this was extended back in 2010 by Congress, and is set to expire here at the end of 2012. A lot of the indications, a lot of the things that we've read is that all indications show us or tell us basically that this will probably most likely not get extended. So what this could do is, if we look at how much money is in non-interest-bearing deposits today, it amounts to about $2.3 trillion. And this could potentially put a lot of money in play into the short-term markets as investors will look to further diversify where they put their money so they don't have too much exposure to any one bank. So what sort of policy actions have we seen take place by the U.S. Federal Reserve and the European Central Bank? One of the things that occurred back in June of 2012 was the extension of Operation Twist. This was a continuation of basically the Federal Reserve selling short-term treasuries in favor of longer-term treasuries. The whole idea of Operation Twist was to their attempt to keep long-term interest rates low so that the economy could grow. And then the other thing that they've recently have announced is QE3, quantitative easing 3. Now, what exactly is this? Well, basically, what quantitative easing is that the Federal Reserve now has announced that they will be purchasing about 40 billion of agency mortgage-backed securities per month for an open-ended amount of time, which is actually unprecedented. So why is this so important? Well, the way this is supposed to work is it'll result in a continuation of low long-term interest rates, particularly for the housing market, to help get the housing market back to recovery. But the other thing it does is because it keeps low long-term interest rates low, the hope is that investors will start to begin taking on more risk, and so therefore putting their money into other asset classes within the financial markets to seek higher returns. As the financial markets perform well as a result of increased demand, this is designed to result in an increase in the wealth effect. And in the increase in the wealth effect for consumers is that the hope is that they will increase consumer spending. As you know, that consumer spending makes up about 2/3 of the overall economy. So that's how the quantitative easing is supposed to work. The other policy action that's taking place is the European Central Bank is actually doing something pretty similar, where they've announced the outright monetary transactions, which basically involves the purchase of short-term securities in the secondary market to supplement some of the other facilities that they have in place. And how this is designed is to make sure that the sovereign governments over in Europe have unlimited access to funding so that they can shore up their banking system. As a lot of you may have read in the press, there's been a lot of issues surrounding the European banking system as well as the sovereign governments. And so one of the questions we get oftentimes asked by clients, well, why is Europe so important to the United States, even if I don't even own European debt? Well, as you all know, we're now a global economy, so all the developed countries are interconnected via the financial system and via all of our local economies. And as you could expect, our economy actually has a lot of exposure to Europe, and the European economy has a lot of exposure to the U.S. So as we've seen take place with issues with Greece and Spain, and even earlier with Portugal and Ireland, it does have ramifications and does result in a lot of volatility, not only in the markets abroad, but also here in the U.S. Next, I'm going to cover just some of the conditions here in the short-term market. This is a very interesting chart here. This is a chart just sort of underscoring sort of the headwinds, not only for money market funds, but also for short-term investors. This just shows, if you take a look at this chart, the blue line actually represents commercial paper outstanding. And if you go back to the credit crisis, it did peak at a high of $2.16 trillion back in July of 2007. And as you can see, with a lot of the leveraging that has occurred in corporate America, and the fact that a lot of corporations are now terming out their debts because there's such low long-term interest rates, there's been a lot less issuance of commercial paper. And as you can see, it's actually dropped off quite precipitously since 2007. And if you go ahead and you take a look at the gray line, The gray line is basically an index that tracks the yield on money market mutual funds and in the institutional class. And as you can see, they are very, very highly correlated. And what this basically tells you is that with the Federal Reserve being very, very highly accommodative and a lot of liquidity that's been put into the system, there's basically just too much money chasing too few assets out there. And so what it does is it has driven down yields. The demand has driven down yields, and the lack of issuance has exacerbated that reduction in yields. And so therefore, one of the largest investments that money market funds invest in is commercial paper. And so therefore, yields on money market mutual funds has decreased. And if you take a look at sort of examples today as far as where a typical government money market fund is yielding today, it's yielding about 1 basis point. If you look at a prime money market fund that does include commercial paper, you'll see that's yielding in the single digits as well, most likely. So this is a very, very challenging condition in the short-term fixed income markets. The other point I wanted to make here too is because I know that a lot of public agencies are investors of agency debt. If you take a look at this gold line, you'll see that this has actually recently started to decline as well. And if you recall, about a month or so ago, there was an announcement by the government that the government-sponsored entities like Fannie Mae and Freddie Mac would be further nationalized. Basically what they have done is, because they're under conservatorship, the government, in order to keep them afloat, has required them historically since the credit crisis to pay Uncle Sam a preferred dividend. What they've done is they've actually stated now, well, all the profits that Fannie Mae and Freddie Mac make now, you're going to go ahead and pay that to the government, which means that they no longer have to pay that preferred dividend. Well, what that's resulted in is a decrease in debt outstanding for the agencies, because before this development, they had to issue more debt in order to pay Uncle Sam its preferred dividend. So now they're just going to be sharing their outright profits with the government, which will now result in less debt outstanding. And so you can expect this gold line actually to start decreasing at an increasing rate. As in addition to that, they've also been mandated to shrink themselves by 10 to 15% per year. So those agencies are slowly being shrunk, and therefore they're issuing a lot less debt. And so you'll start to see yields continue to decline in that market as well. So one of the points that I also wanted to make was, if you take a look at this chart just shows the yield on the 10-year U.S. Treasury. And despite the downgrade back in August of 2011 by S&P, the U.S. Treasury market continues to remain a safe haven for global investors abroad. And so if you go ahead and you take a look at the market mentality, say over the last year and a half or so, it's sort of been in a risk-on, risk-off mode. To the extent that there's a lot of uncertainty into the markets, we tend to be in a risk-off mode, and you'll see monies flow into the Treasury market as that's considered a safe haven, and investors shunning risk assets, so anything other than Treasuries. And so that's what happens in a risk-off market. And then when things start to settle down, there's a bit less uncertainty in the market. You start to see investors actually take more risk, and so they'll tend to sell their Treasuries and buy other assets that are associated with risk. And as you can see by this chart, actually, if we look back at in July, the end of July, the 10-year Treasury actually reached an all-time low of 1.39%. Again, this despite the downgrade back in August of 2011. And then just recently today, the 10-year is pretty close to 169. It closed today at 1.72%. So I talked about the risk-on, risk-off mentality. You know, one of the ways that we track volatility in the market is we take a look at the VIX index. And the VIX index, without getting too technical, is basically an index of volatility that we track. And as you can see, if you go back to October of 2008, that's where it peaked, and that was at the peak of the credit crisis. But as you can see, since then, there's been a lot of peaks and valleys and a lot of volatility between 2008 and today, and a lot of that's been, you know, having to do with what's been going on in over in Europe. So, for example, you know, if you look back at October 2011, that was probably the peak of what was going on with Greece, and then that peak post October 2011. You can see kind of where Spain had reared its ugly head, and that created a lot of uncertainty. And so you saw volatility spike. The reason why this is so important is, again, when we start to see volatility spike, the market tends to go into a risk-off mode. And so that's when you tend to see riskier assets shunned in the marketplace or sold in the marketplace, and the treasury market tends to rally as a result of that. Now, if you take a look at this chart, here what we're doing is we're looking at the volatility in the corporate bond market. And I'm going to back up a little bit because I want you to see the pattern here. If you take a look at the shape of this graph here, and you show the pattern of volatility, it greatly mirrors the volatility measured in the form of spread. And what spread basically is the risk premium that corporates have to pay above and beyond the risk-free rate. So, for example, a treasury rate. And here what we're doing is we're measuring those risk premiums for 2-year single A rated corporate bonds. And even for a 2-year single A rated corporate bond, that's been very volatile again, as you've had this risk on, risk off mentality. When you see these spreads spiking, for example, back here in October of 2008, you'll see that people are selling corporate bonds and they're actually buying treasury bonds. And as they sell their corporate bonds, the corporate bond prices are falling and the corporate yields are rising. And so that's what causes this rise in spread. So as you can see, is one of the things that we pay attention to is how volatile this spread has been, because you want to make sure that you're buying low and selling high. And so we want to make sure that we're capturing those risk premiums when in fact they do make sense. And here, the spreads that we're actually tracking here are the spreads of bank and brokerage as depicted by the blue line, finance companies as depicted by the gold line, and industrial companies as depicted by the gray line. And the reason why we show these particular sectors, if we take a look at bank and brokerage and finance, for example, these issuers actually tend to dominate the short-term market because funding is so essential to their business model. And as you can see, just recently, we've had this pattern is after the last spike in spreads, we've actually had quite a bit of spread narrowing, which should tell you if the risk premiums are declining, the risk environment is getting better. And I'll talk more about that later on in the presentation. So financial spreads do remain elevated relative to other sectors of the market, and industrials actually, if you take a look at the gray line, it's been a much more stable part of the market. So we've taken a look at spreads. So let's translate that into what it looks like from a yield perspective. And across the board, yields are well off their highs that we saw back in 2008. And what we're looking at here is we're actually looking at 2-year corporate bond yields. And what we've shown here is various areas of the credit curve. So if we look at this black line down here, this is the 2-year treasury, okay? And that's yielding, when we have this chart put together just recently, it's at 28 basis points. And then we're actually taking a look at how much of a spread over the 2-year treasury yield is a AA corporate bond. So AA corporate bonds are averaging about 56 basis points in yield. And then the single A corporate bond yields are about 73 basis points as depicted by the gold line. And then finally, if you were to go to the very bottom of investment grade, you can see the yield pickup there up to a yield of 1.21%. So that's what yields look like from a credit quality standpoint in the corporate bond market. So one of the things that we wanted to highlight today is, when you get into a risk on, risk off mode, and there's a lot of uncertainty in the market, what you'll tend to see is, again, money's flowing into the treasury market because that's considered the safest sector of the bond market. But it isn't exactly a risk-free. It may be risk-free from a credit standpoint, but it does carry some risk. And what it does carry, what kind of risk it does carry, I wanted to sort of highlight to you. Let me just back up one slide here. If we go back and we look at 2008, this chart here depicts the U.S. Treasury yield curve. And so we're showing what the yield curve looked like back in 2007 as depicted by the gold line. So this is the term structure of interest rates and what it looked like back in 2007. So from very short treasuries here all the way out the yield curve to 30-year maturities. This is what the term structure of interest rates look like. Well, as a result of the credit crisis, what we found is that not only was the Federal Reserve highly accommodative, and that's why you see the front end of the yield curve drop so precipitously, but we saw money flows into the Treasury market across the curve, and that's why you see this parallel shift down. If you recall, as bond prices rise, yields fall, and so this is just all the flight to quality that we saw in the U.S. Treasury market back in 2008. And so one of the things that I wanted to highlight today is how does that translate into total return? Well, if you go ahead, and I'm going to go ahead and take a look at the extremes here just to make my point. So bear with me here. If we go back and we take a look at where this area of the curve, the 10-year area of the curve, and out performed, given this decrease in yields, because monies were flowing into the Treasury market, what we saw was a total return for maturities 10 years and over, a return of 24.36% for 2008. Now that's an unbelievable return, right? When you're taking no risk in the form of credit risk. If you go ahead and you dissect this return, 18.08% of that 24% return came in the form of price return. So again, we look at total return. Total return is actually comprised of your price return, but also your income, because bonds do pay coupons. So what I've done is I've just simply dissected where the returns have come from between price and income. And as you can see, most of the return came in the form of price. And this is going to be a very, very important component. So in a risk-off mode, the Treasury market tends to perform very, very well, particularly on the longer end in the form of price return. Now, why is this important? Well, what the market giveth, the market can also taketh away. And if we go ahead and we take a look at what happened back in 2009, you'll see that interest rates actually rose here. As you can see by the front end of the yield curve, the Federal Reserve did not change monetary policy. If they do, then this front end tends to shift, okay? But what ended up happening was that you had some of the dust settling from the credit crisis, and so you saw the unwinding of that safe haven trade in the Treasury market. And so you saw people leave the Treasury market and investors actually start taking risk again. And so the point I want to make here is, number one, you don't need the Federal Reserve to actually change monetary policy in order to have interest rates change. And so if we go ahead and we take a look, okay, so where we were at the end of 2008 by this gold line, and then where we were at the end of 2009, you see that rates were pretty significantly higher a year later. Now, how does this translate in the form of return? Well, as yields rise, bond prices fall. So what you take a look, we look at the same area of the curve, and while before we had a positive 24% plus return, now we're looking at a negative total return of 13%, okay? And again, you go ahead and you take a look at that price depreciation associated with that rise in interest rates, and most of that came in the form of price depreciation, and there was a very, very little amount of return coming from income. So one of the things you need to be cognizant of is if you're camped out in treasuries, you just need to be aware of the sort of interest rate risk exposure that you potentially may have. Now, some clients ask, well, Mike, why would I be, concerned with interest rate risk if I plan to hold these to maturity? Well, that's a very good question, and chances are, if you were to hold your treasuries to maturity, then you're not going to expose yourself to interest rate risk. But what we find is, and our experience has been, you never know when you may have to tap your portfolio. There could be an unforeseen liquidity need that you may run into where you're going to have to sell from your portfolio, in which case you really need to be paying attention to what sort of interest rate risk exposure that you have. So let me go and we'll look at one more example of this. Again, you go back to 2011, this is when Europe sort of reared its ugly head, and again, this was an example of a risk-off mode. And again, we see the same pattern when we saw a parallel shift here out in longer maturities all the way down, from the end of 2010 to the end of 2011. Again, we go ahead and we take a look at those longer maturities and what happened in the form of a total return. We had equity-like returns here, right, for treasury bonds. And we had returns just over 29%. Again, most of that coming in the form of price return. And as you can see, very little of it coming in the form of income return. So the point is, you got to be very, very cognizant of your interest rate exposure, given how bad bond prices could rise or fall given changes in the interest rate environment. So that leads us to, where do we see value? Well, at Wells Capital Management, one of the things that we've been, discussing with the Board of Trustees for CalTRUST is that we're more advocates in this particular environment of taking credit risk as opposed to interest rate risk. What ends up happening is that oftentimes when you find yourself in a very low interest rate environment, investors seek to go out the yield curve for higher yields as opposed to looking for other alternatives. And so where we're seeing value is in corporate bonds. And I know that 53601, the Cal Code, limits your exposure to 30%. But we do think that it makes sense here to buy corporate bonds and also to look at municipal bonds. There's been some significant developments there too. And so when we're looking at diversifying our portfolios, we're actually underweight treasuries and agencies, just given that interest rates are so low and that there are better opportunities elsewhere. And I'm going to go ahead and kind of walk through why we think that makes sense to give you a sense of our rationale. So here is what we view as sort of the risk-reward trade-off. And so let me just describe this graph briefly. Along your y-axis here, you have average rolling returns, 12-month returns over the last 15 years or so. Okay, and if you take a look at what we've actually charted here, we've actually charted baskets of bonds, basically. So Merrill Lynch, what they do is they track baskets of bonds for various maturities in various sectors. And they track those, and money managers use them as benchmarks. And so we have the average rolling 12-month returns over this time period, dating all the way back to 1997. And then along your x-axis here is we measure volatility in the form of standard deviation. So that's how we sort of define risk in the bond market, is how volatile have the returns been. And basically, what we want to show you is the risk-reward trade-off. If we go ahead and we take a look at this bottom index, this is a Merrill Lynch index. Again, it's a basket of bonds that have maturities between 1 and 5 years, and they're all treasury bonds. And so we plotted this, and you can see it's between just over 4.95%, the average return of a treasury bond with a maturity between 1 and 5 years, and its standard deviation is about 3. And one of the things that I want you to be cognizant of here is as we move up, okay, we go from the Merrill Lynch 1 to 5 year Treasury Index, and now we're moving to the 1 to 5 year Corporate Government Index. And these actually incorporate, it's mostly government bonds in this particular index, but it does have a component of corporate bonds. Again, we're looking at maturities between 1 and 5 years, and the corporate bonds have a credit rating of AA+. And as you can see, your risk, as measured by standard deviation, actually decreases very, very slightly. But you also get a pretty good increase in return of about 10 basis points, okay, just by adding a little bit of corporate bond exposure. And if we go up one more to this next index, here's the Merrill Lynch 1 to 5 year Corporate Government Index. Now this includes corporate bonds that have a credit rating of single A+ and above, okay? And if you were to ask me what the breakdown is of this index, about 80% of this particular index here has treasuries and agencies in it, and 20% of the index has corporate bonds in it, okay? And as you can see, again, a slight reduction in risk is measured by standard deviation, but you have a higher return. And then if we take it one step further and we incorporate all investment-grade corporate bonds, again, the mix here is about 70% government bonds and 30% corporate bonds. Again, you get a bit less risk here as measured by standard deviation, and you get a very nice reward in the form of an increase in return. So this is why we look at corporate bonds and we consider them, and why we think they make sense in a lot of portfolios. But let's just take this one step further. Let's take a look at the range of returns during the same time period. This is the same information, and what we're actually tracking, again, down here along your x-axis is you have all the same indexes that I discussed before. And if we look at the 1 to 5 year Treasury Index, over this time period, this 15-year time period, you'll see that the highest return during the 15-year period on a 12-month rolling return basis was 11.4%. The worst return for the 1 to 5-year Treasury index was negative 80 basis points. And the average return, is depicted by this white line here, was about just shy of 5%. Okay? And so, again, if we go and move over to the right here, we start to incorporate a bit of corporate exposure into the index. Again, adding AA bonds to the index, our ranges change a little bit. The highest is a bit higher than the 11.41%, right? So the high for this, including AA corporate bonds, is just shy of 12%. The average return goes from 4.96% to 5.06%. But here, this is very interesting here. You have a higher negative total return for treasuries versus the index that actually includes corporate bonds. Okay? And again, we go further out to the right, we include single A and above corporate bonds in this index. And again, we're looking at 80% government bonds here and 20% corporate bonds for single A and above. And you go from 5.06% average return over that 15-year period to 5.13%. You go from 11.89% to 11.99%. Again, your downside here is minimized even further. And the same thing to the far right here, where your downside is reduced a little further here, and your average returns a bit higher. So this is why we think that from a risk-reward standpoint, corporate bonds can make a lot of sense. Now, one question we oftentimes get from clients is, well, Mike, with the economy growing so slowly, are you comfortable with corporate bonds given the fragility of the economy and the fact that we're growing, at about a 2% annual rate? And so one of the reasons why we're comfortable with corporate bonds is because if you take a look at what's occurred post the credit crisis, you'll notice that, again, I mentioned this earlier, that a lot of corporate America has deleveraged. Corporate balance sheets are the healthiest that they've ever been as a result of the aftermath of the credit crisis. And credit fundamentals, in our opinion, are very, very, very strong. And this chart just sort of illustrates that, where corporate profitability is very, very strong based upon historical basis, and corporate cash flow is very, very strong. And so, again, as opposed to taking interest rate risk, we think that taking credit risk makes a lot of sense here. But I will say that you need to be very, very careful when you take that corporate exposure, because you really need to understand the business and the risks associated with the various issuers that you may be buying debt from. So we showed this before. These are the risk premiums that I talked about earlier for 2-year A-rated corporate bonds. And as you can see, everybody's got a thirst for yield. And so as a result, the corporate bond market, this reduction in risk premiums over time, as you can see, actually what this translates into is good, strong performance in the corporate bond market. And so while they have come off their highs and they are approaching, these levels of 32 basis points risk premium for industrial issuers at the 2-year A-rated corporate bond space, 73 basis points for finance companies, and 85 basis points, we still think that there will be very good underlying demand for corporate bonds, given the fact that interest rates are so low and investors are actually looking beyond treasuries for yield. So we think that this will continue to be a very good, well-bid market, and we expect it to perform well going forward. And again, going back to the yields, here's where we go ahead and we take a look and magnify here the yield environment here. Again, the black line being 2-year yield on treasuries, and then looking at further at the credit curve. So AA corporate yields at 56 basis points, single A corporates at 73 basis points, and then bottom investment grade triple Bs at 121 basis points. So again, we think that corporate bonds make a lot of sense. The other reason why we think that they make a lot of sense is because they can be a very, very good defensive play in the face of a rising rate environment. And while we may be a ways off where the Federal Reserve is actually going to tighten monetary policy, as you saw by my yield curve illustrations earlier, the Fed rates the Fed doesn't necessarily have to get involved in raising or tightening monetary policy in order for interest rates to rise. And so one of the things that I wanted to illustrate here, whoops, I think we went too far. One of the things I wanted to illustrate here is in a rising rate environment, coupons can provide that insulation to negative price action. If you recall back at those high treasury returns, a lot of the return came from price. And so what I've done here is a simple comparison looking at a 1 to 3 year corporate bond index. So this is the basket of corporate bonds with maturities between 1 and 3 years. Okay, and then I'm looking at a basket of bonds, treasury bonds with maturities between 1 and 3 years. And one of the things that we do for CalTRUST actually is we oftentimes will do a shock analysis so they can understand what the potential volatility in the NAV potentially could be if, in fact, rates were to rise or fall for that matter. But given where interest rates are right now, we really think that the risk is really to the upside where the next move is going to obviously be up as opposed to down because rates can't go much further. So if we go ahead and we take a look at an interest rate scenario, and I'm going to look at this top line right here. Let's just assume that there's no change in interest rates. The total return on a corporate bond would be 1.67%. Okay, you're going to have zero price return because interest rates haven't changed, so bond price would stay the same. And then you're going to clip that coupon, and so your total return will basically be the coupon. Okay, the same thing with the treasury. The big difference here is look at the difference between the income component of the coupon. In the corporate bonds, with maturities between 1 and 3 years, you have a coupon of roughly 1.67%. And in 1 to 3 year treasuries, your coupon is 29 basis points. So very, very little in the form of an income return. Now look what happens when you start to rise, when interest rates start to rise. So if we increase interest rates in increments of 25 basis points, here's what happens to the total return. I'm going to go ahead and take a look at what occurs if interest rates were to rise by 100 basis points. Or actually, let's do this. Let's take a look at 50 basis points. So if we just have a 50 basis point move in interest rates, corporate bonds would be expected to, with maturities between 1 and 3 years, would have an expected total return of 73 basis points. You'd have negative 95 basis points in the form of price return, but the income acts as kind of a shock absorber. So if you do the math, your total return is 73 basis points. 168 basis points, or 1.68% of that coming in the form of income, and you're losing roughly 1% in the form of price. But your total return is 73 basis points if you have exposure to corporate bonds. If you look at what happens to treasuries, because your coupon is at such a low rate, it doesn't take much in the form of a price move for you to get into a total return situation with treasuries. And again, looking at maturities between 1 and 3 years. Even if rates were to go up by 25 basis points, you're looking at a potential negative total return of 16 basis points. So this just goes to show you that corporate bonds can make sense, again, given the positive credit fundamentals out there, and understanding, doing your homework and understanding the credit risk that you're taking. But it's also a good way to play defense in the face of a potential rising rate environment. And then all the way over to the far right just shows the outperformance showing corporates versus treasuries given the increase in increments of 25 basis points. Here's the outperformance of corporate bonds versus treasuries. And then down below, we've actually just kind of graphed everything. Sometimes the picture is worth 1,000 words. So we've included this graph, which I think is quite compelling. So the other thing that we talked about is where we're seeing value is in municipal bonds. And as you all well know, you know a lot about, probably a little more about the muni market than I do, but since you're issuers of a lot of that debt. But here's our money manager perspective on the municipal sector. One of the things that's taken place, one of the structural changes that's taken place in the muni market is that post the credit crisis, there's just a lot less municipal bond insurance out there. And when we had the municipal bond insurance, it sort of homogenized that market where you really didn't need to do a whole lot of credit work, and you sort of relied on the bond insurers to make sure that that was mitigating your credit risk. And if we go back to 2005, I believe roughly 60% of the muni bond market was actually insured. Post the credit crisis and a lot of those monoline insurance companies going away, now that that stands at about 5% of the muni markets insured. And so what's occurred is that it's caused a lot of inefficiency in the municipal bond market, which is actually translated into a lot of opportunity for institutional investors, particularly those investors that do their homework. And one of the things that we rely on quite heavily, not only in the corporate bond sector, but also in the municipal sector, is understanding the issuers and the structures of municipal bonds that we've been buying. And we view actually the municipal bond sector actually not only is very opportunistic, but also a very good defensive play, because the municipal bond market is very, very, very resilient. And so what we've been doing is actually buying a lot of municipal bonds in actual taxable portfolios that can't even benefit by the tax exempt, just merely because there's actually been some cases where municipal bonds are actually higher yielding than some of the corporate debt that we've seen out there. And so one of the ways that we get clients comfortable is we show this graph or this table on the right side showing comparative default rates relative to the corporate bond market. And as you can see, if you look at the comparative default rates for municipal debt versus corporate debt, and here we're looking at triple B municipal bonds versus corporate bonds, you can see that they're very, very, very resilient. And so, you know, the cumulative default rates being less than AAA corporate bonds gets us very, very, very comfortable. And again, it's a matter of just demonstrating empirically the fact that this does represent less risk and a lot more opportunity. Now, having said that, a lot of the things obviously that we have to deal with is a lot of the headline risks that are associated with municipal bonds. And, you know, that's something that we've been having to combat over the last couple of years, where a lot of headlines will come out and it'll introduce a lot of volatility to the market, and we get a lot of questions for clients. And so, you know, one of the things that we wanted to do was just frame some context in that, you know, again, if you look at the municipal bond market, it represents about 3.7 trillion in debt outstanding. And I know that we've had a lot of municipal headlines, and we've had a lot of headlines with respect to defaults. And so that's some context that we try to provide clients as well. And so what we've done is we've tracked actually the defaults that have occurred going back to 2008. And as you can see here, it was about just over 8 billion. And then here in the parentheses are actually missed payments. And as you can see, the actual default rates as a percentage of the entire municipal bond market has been very, 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 very low. Here in 2000 and back in 2008, it was, you know, 0.22% of the entire bond market, entire municipal bond market. So very, 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 very low in the greater context of things. And if you go ahead and you take a look at even where the high was, which was last year in 2011, where we had, you know, just over 25 billion in defaults. Again, 25 billion in defaults, but only 2.4 billion in actual missed payments. And again, if you take a look at this $25 billion number and use that as your numerator, it still only equates to just over half of 1% of the entire municipal bond market. So again, we view this as a very, very safe sector of the bond market, one in which there's lots of opportunity, particularly if you do your homework on the bonds. For example, we're actually playing defense right now in the muni bond market. So the types of bonds that we're buying in portfolios are, for example, essential service revenue bonds, where we're buying, sewer bonds or higher education bonds or airport bonds, that sort of thing. Those essential services that we know aren't going to go away no matter how bad the economy gets. So there are ways within the context of a particular bond sector to actually add value to your portfolio. But again, you really need to do the credit homework to understand the issuer and the structures that you're buying. The other thing that I want to make a point is a case for municipal bonds is, again, not only is it a very resilient market, but it's also a great way to play defense in the face of a rising rate environment as well. And so one of the things that I've done here is I've actually taken a look at 5-year monthly correlations. And I've taken a look and compared them to other sectors of the bond market, okay? And so if we take a look at this correlation matrix, you have municipal bonds up here at the top. So municipal bonds to municipal bonds is a positive, perfect correlated market, right? But again, I showed you that series of yield curves, and to the extent that we do get, more money leaving the treasury market, and we do get higher rates in the treasury market as a result of the unwinding of the safe haven trade, municipal bonds have a very low correlation with U.S. Treasuries. It's only 14 basis points of correlation, okay? And they're very, very low. They have a very, very low correlation as well to agencies, okay? And it's just shy of 50 basis points for corporate bonds. So again, as interest rates rise, municipal bonds will rise to a much lesser extent. And a lot of that's due to the fact that it's a retail-based market, and those tend to be more buy and hold markets. So you get a lot less volatility in the municipal bond market. So again, from a risk-rewards trade-off standpoint, we think that there's great opportunity because the reward makes sense, but more importantly, again, doing your homework, it's a great place to take a lot less risk as it relates to volatility. So, ways to achieve your portfolio objectives. Well, one of the ways, and I think the great value of CalTRUST is it provides public agencies within the state of California a very good platform in which to make investment choices and place your funds. And so there's 3 funds that are offered. The money market fund that's got a weighted average life of 31 days and is currently yielding about 15 basis points. The short-term fund, which is just at a half a year from a weighted average life standpoint and yielding about 34 basis points. And then we actually have a longer fund, a medium-term fund, that would make sense for those funds that you may not have to touch for a while, that's invested out a little bit further, where the weighted average life is about 1.8 years, and that's yielding about 79 basis points. So all 3 platforms are Cal Code compliant. Other ways in which you can do this is actually if you have enough scale in your portfolio. In other words, your portfolio is sizable enough to structure an individually managed institutional portfolio. You could look at outsourcing a separately managed account to a professional money management firm. Again, I would say that one thing you might want to concentrate on is what sort of risk management practices do they employ, just to make sure that those risks are being appropriately addressed. And then again, you could also go ahead and self-direct your own portfolio in-house, which is probably something that you're doing today, but to the extent that you venture outside of the Treasury agency sector, I do really emphasize that make sure you're doing your homework when you're looking to other sectors of the market. And with that, I will wrap it up and take questions. I'd also like to make myself available. I'm also available. My contact information is right here, as well as Lyle Deffenbaugh, who serves as the Director of Client Services for CalTRUST. And Laura, I'd be happy to take any questions.
It does not look like we actually have any questions at this time. If any attendees do have questions, you can expand your little GoToWebinar control panel on the right-hand side and type them into the questions box. I don't actually see any. Anybody? Give it a minute to see if any pop up. Doesn't look it. Well, all right, everybody. Thank you all for your time this afternoon. This is just the first in a series of webinars that CalTRUST is planning to host as part of our education program. If you have any ideas for any other webinar topics that you would like to see us covered, please feel free to contact myself or Lyle Deffenbaugh. And I think we do actually have, well, we just had one question come in. Someone would like to know, how long do I have to invest my funds in the medium-term fund?
So the medium-term fund is, again, designed for more funds that you're not going to need immediately, and liquidity is actually offered on a monthly basis. So once a month, you're able to take money out of the medium-term fund, as opposed to the short-term fund, which is a daily liquidity. You can take money out daily in the short-term fund, but the medium-term fund, it's once a month.
Thank you. Someone else has asked if the webinar is recorded and can be viewed again later, and if copies of the PowerPoint are available. We did record this webinar, and both the recording of the webinar and the PowerPoint will be available on our website by the end of the week. Any other questions? Well, it does not look like there are any other questions. So thank you everyone for joining us today. Thank you, Mike, Wells Capital Management, for putting on this presentation for us.
Thank you.
That will conclude our webinar. Thanks, everyone.